Okay, greetings from IBI, India Business Insights. India Business Insights is a new business channel from India focusing on deep research on various issues affecting the Indian business and economy. Today we are going to present a brief overview of the Indian economy as we speak. So first of all, let us look at our GDP. While our GDP fell last year due to the severe impact of COVID and lockdowns, I am very pleased to inform that the GDP recovered at the rate of 8.7% during the current fiscal year, and this brings the current GDP above the pre-pandemic levels. So for last year, we grew at 8.7%. This was the fastest growth amongst the major economies in the world. And for financial year 2022, India's GDP at current prices is estimated at Indian rupees 236 trillion, roughly equivalent to US dollars 3.01 trillion, as against 1.98 trillion rupees, roughly equivalent to US dollars 2.55 trillion in the last year. The most important and fastest growing sectors of the Indian economy are the services, trade, hotels, transport, telecommunication, financing, insurance, real estate and business services, community, social and personal services account for more than 60% of the GDP. Agriculture, forestry, fishing constitute about 12% of the total GDP, where they employ about 50% of the total labor force. Manufacturing accounts for only 15% of the GDP, and construction accounts for about 8% of the GDP. Mining, quarry, electricity, gas and water supply account for remaining 5% of the GDP. Each of the sectors of constituent sectors of GDP showed significant growth during the last year. Now let's look at the foreign exchange reserves. During the last year, reserves decreased from US dollar $635.3 billion to US dollar $590 billion. The half-year decrease was from $635 billion in September 2021 to $607.31 billion as at the end of March 2022. The Indian currency, Rupee, hit a fresh low of 71.937 as of yesterday, plunging 6% this year. This is on account of accelerating inflation, worsening external finances, and persistent capital outflows persistent capital outflows at the back of a slightly weak stock market. Higher crude prices and other commodity prices and a sudden surge of gold imports in May and June have significantly widened India's trade gap and in turn the current account deficit. The government has hiked the import duty on gold and raised export taxes on gasoline and diesel to tame the fast widening current account gap. However, similar pattern has been seen in the currencies of China, Thailand, Malaysia and other countries. These currencies have fallen in spite of having relatively higher current account surpluses, and even their central banks have not been as tight as Reserve Bank of India in terms of their monetary policy. The Philippine peso and Korean won have performed much worse. The tense geopolitical situation have caused a deep weakening of the euro. So while Rupee has lost against the dollar, it has gained significantly against the euro. On the back of a rising inflation And on global cues, the interest rates in India have also started rising. The yield on the 10-year government bond, while it has recently eased to 7.4%, it is still not very far away from the 3-year high of 7.6% hit in June, earlier in June. The retail inflation has also softened a bit and is expected to be 7.04% in May, down from 7.79% in the previous month. India's bond yields have climbed more than 100 basis points this year, tracking a global rise in borrowing costs. On the domestic front, the Reserve Bank of India has also raised key interest rates by 50 basis points in June after a surprise 40 basis points off-cycle rate hike in May, tracking most other central banks. We will talk a little further about the recent meeting of MPC slightly later in the same video. Foreign trade. India's overall exports, that's merchant and service exports, are estimated to be US dollar $125.59 billion, exhibiting a growth of 25.9% over the same year. These figures also represent a smart growth over the trailing few months, that is the last quarter of last year, financial year. Overall imports in April-May are estimated to be US dollar $151.89 billion, exhibiting a growth of 45.44% over the last year. This has resulted in a slightly higher trade deficit. However, this also represents a broadening of the recovery in economic activity. Urban demand is recovering and rural demand is also gradually improving. Merchant exports posted robust double-digit growth for the 15th month in a row during May. Imports rose 62.8% to US dollar $63.22 billion amid surging purchase value of crude, petroleum, and other products. So exports also rose a softer 20.6% in May and were at $38.94 billion. The credit rating, most of our credit ratings have been stable. Fitch, while it maintained its credit rating, has revised the outlook from stable to negative. The current credit ratings are all well into the investment grade. Fitch is at BBB minus, Standard & Poor is at BBB minus, and you will find here on the slide a brief history of our credit rating evolution. Inflation. The RBI has revised India's inflation projection to 6.7% for the year from the earlier revised estimate of 5.7%. The protracted nature of the Russia-Ukraine war puts pressure on commodity prices globally. The CPI has increased from 7.0% in March 2022 to 7.8%, and as we have earlier noted, this may soften somewhat during the month of May. The consumer food prices rose from 8.38% in April and from 7.68% in March. Employment rate. The employment rate in India increased to 42.30% in the third quarter of 2021 from 40.90%. Employment rate represents the total number of persons out of the total population who are currently in gainful employment. Consumer confidence. The consumer confidence of the current period has been consistently improving since July 2021. The sentiments on the key parameters like employment and household income improved further in the latest round of the survey, though they remain in the pessimistic zone. Households assessed a rise in their current spending and expect it to increase further over the next 1 year. They expected higher essential spending, whereas the sentiments on non-essential spending remain downbeat. Yeah. The last Monetary Policy Committee of the Reserve Bank of India presented its outlook on the Indian economy. So, as per the resolution of the MPC, the 10th we summarize their findings. The tense global situation and consequent elevated commodity prices impart considerable uncertainty to the domestic inflation outlook. The restrictions on wheat export should improve domestic supplies. The forecast of a normal southwest monsoon augurs well for the Kharif agricultural production and food price outlook. Edible oil prices remain under pressure on adverse global supply conditions. Notwithstanding some recent corrections due to the lifting of export ban by a major supplier. Consequent to the recent reduction in excise duties, domestic retail prices of petroleum products have moderated. International crude prices, while they have remained elevated, we have seen a recent softening in the last 1 week of domestic crude, of the international crude prices. There are also upside risks from the revision of prices of electricity. Early results from manufacturing services and infrastructure sector firms polled in the RBI survey expect further input and output price pressures going forward. Take into account these factors and then on the assumption of a normal monsoon in 2022, an average crude oil price of US dollar 105 per barrel, inflation is now projected at 6.7% in 2022-23, with Q1 at 7.5%, Q2 at 7.4%, Q3 at 6.2%, and Q4 at 5.8%, with risks evenly balanced. Investment activity is expected to be supported by improving capacity utilization, government's capex push, and strengthening bank credit. Growth of merchandise and service exports is set to sustain the recent buoyancy. Spillover from prolonged geopolitical tensions, elevated commodity prices, continued supply bottlenecks, and tightening global financial conditions nevertheless weigh on the outlook. Taking all these factors into consideration, the real GDP growth projection for 2023 is retained at 7.2%, 3 with Q1 at 16.2%, Q2 at 6.2%, Q3 at 4.1%, and Q4 at 4.0%, with risks broadly balanced. Inflation risks flagged in April and May resolution of the MPC have materialized. The projections indicate that the inflation is likely to remain above the tolerance level of 6% through the first 3 quarters of 2022-23. Considerable uncertainty surrounds the inflation trajectory due to global growth risks and geopolitical tensions. The supply side measures taken by the government would help to alleviate some cost push pressures. Persisting inflation pressures could also set in motion second round effects on headline CPI. Hence, there is a need for calibrated monetary policy action to keep inflation expectations anchored and restrain the broadening of price pressures. Accordingly, the MPC decided to increase the policy repo rate by 50 basis points to 4.90%. The MPC also decided to remain focused on withdrawal of accommodation to ensure that inflation remains within the target going forward while supporting growth. High frequency indicators. The rise in industrial investment IIP index of 7.1% is the highest in 8 months. mainly led by good growth in power and mining sector, which grew by 11.8% and 7.8% respectively. Manufacturing sector recorded a growth of 6.3% in the first month of the current fiscal year. The primary goods, intermediate goods, infrastructure, construction goods, and consumer non-durable sectors expanded by 10.1%, 7.6%, 3.8%, and 0.3% respectively. Most automotive manufacturers, apart from Maruti Suzuki, reported very handsome year-on-year growths in their output. The automotive industry saw a drastic increase in demand in May 2022 as compared to May 2021. Tata Motors and Mahindra's were the biggest beneficiaries of this demand growth and saw over 200% year-on-year growth in sales. With the excitement of new launches, better availability of semiconductor chips, and improved consumer sentiment in rural areas, automotive industry looks in a strong position. Purchase Managers Index. Manufacturing sector in India steadied in May with new orders and production increases at similar rates to those registered in April. Companies were able to secure new work despite lifting selling prices at the fastest rate in over 8.5 years, as additional cost burdens continued to be transferred to clients. Total sales were boosted by a substantial upturn in international orders, the strongest in over 11 years. At 54.6 in May, little change from 54.7 in April, the seasonally adjusted Standard & Poor Global India Manufacturing Purchasing Managers Index pointed to a sustained recovery across the sectors. The above 50.0 reading was the 11th in as many months and consistent with the solid improvement in operating conditions. Demand showed signs of resilience in May, improving further in spite of another uptick in selling prices. Companies reported a marked increase in total new orders that was broadly similar to April. The Standard & Poor India Services PMI increased to 58.9, the highest since 2011 from 57.9 in April. The latest figure also shows 10th straight month of growth in services activity, buoyed by a substantial pickup in new business growth as demand continued to recover following the reopening of the economy after COVID-19 lockdowns. We hope to bring you similar reports on the outlook of the Indian economy, perhaps occasional small snippets on the Indian economy. We'll try to announce occasional news on the economy or whenever official numbers get reported from time to time. Since you got here, I'm sure you've liked this video, and I would urge you to subscribe to our channel. We plan to give you regular updates, perhaps two to three new videos every day from the coming weeks. Thank you very much.